Good afternoon. Well, last week was an up week for markets. Global equities are up a couple of percent or so, and this reversed the declines of the previous week. And very much the pattern for the last month or so actually has been 1 week up, 1 week down. And essentially, global equities in local currency terms at least have gone nowhere. This obviously follows the very sharp bounce you had from the lows back in March. In sterling terms, which is the dark red line, actually the upward trend has continued. And the reason for this is very simple, and that is that the pound has come under renewed pressure again. And the main reason for this is that once again we are staring at possibly a no-deal Brexit at the end of the year. The latest EU-UK trade negotiations ended on a tetchy note, with no progress being made, and the UK is still adamant that we will not be seeking an extension. Anyway, that's where we are at the moment. Where do we go from here? Well, I think it really all depends on what kind of economic recovery you see over the next year or so. And people have been struggling to describe this recovery and have been describing it with a variety of letters of the alphabet, and these range from an L shape, a U shape, a V shape, and even a Z shape, and a W shape. And our sort of feeling is that the one the market is probably most convinced is going to happen is actually a V shape, which means a sharp bounce back, just as you had a very sharp fall into recession. And that we think is probably the most unlikely to occur. And the only real reason to think that you would get a V-shaped recovery is if you saw a vaccine being developed and rolled out in short order, and that looks pretty unlikely, even though obviously we have now got President Trump launching Operation Warp Speed in the States to develop a vaccine. Most experts still very much think that a vaccine is not going to be available for mass distribution until the middle of next year at the earliest. So I think how the markets play out from here is very much going to depend on the shape of the recovery. And actually, for choice, we would go with a swoosh shape, the Nike swoosh, rather than a letter of the alphabet to describe the outlook from here. And essentially, what this means is it's not going to be that rapid a recovery. The initial stages could be quite rapid, just because you're coming back from such a low level. But then, as it were, it's going to become much harder to regain the levels of activity pre-COVID. So an initial bounce, but then things are going to slow down again in terms of the pace of the recovery. Why do we say that? Well, there's sort of a number of things you've got to consider. One of them is what's going on with business, and actually we had the PMIs, the business confidence numbers out for May last week, and superficially at least they look quite encouraging, quite a nice bounce in confidence. Not so good though when you take into account where they come from and where they've got to. Essentially they fell in April to unprecedented low levels, and all you've got back to now is the lows seen in the global financial crisis. So you're not back up to sort of businesses saying things are improving, they're just not as bad as they were. Another source of uncertainty concerns the consumer, and what's going on here is that unemployment is now shooting up, both in the US and the UK to a lesser extent. We saw jobless claims in the UK rise by 850,000 last month, and it's now looking quite likely that the unemployment rate in the UK could head up towards around 10% over coming months. And if this does happen, this raises the question about how quickly these newly unemployed people will be employed again. Another area of uncertainty is what happens to savings. Obviously, savings rates have actually gone up quite a lot in the last couple of months, just because a lot of people are still being paid, but they've got nothing to spend the money on. And the question is, as it were, whether they will come out and spend these savings, or whether they'll be held back by caution, by social distancing, or just lack of opportunities, given some sectors will remain under semi-lockdown for quite a period. So there's big uncertainties about how rapid a bounce back in consumer spending you get. Clearly, another big player here is the authorities, and you've already seen an unprecedented policy response, and you're going to get more. On the monetary front in the UK, it looks like the Bank of England is going to come up with further action. Most likely in the next month or two, they will expand their quantitative easing program, which at the moment totals around 200 billion. Quite likely they'll increase it to 300 billion. And actually, the bank is now contemplating whether to cut rates into negative territory. Currently, the bank rate is 0.1%, and now they're talking about pushing it into negative territory. Previously, they've opposed this, but now they are actively reviewing it. Elsewhere, you've got a big recovery fund being set up in Europe, hopefully, and also possibly another big fiscal stimulus package in the States. So quite a lot of uncertainty on all these fronts, but in a way, the elephant in the room still remains what happens to the virus and how sustainable these lockdowns or the relaxation of lockdowns really are. All of this doesn't just depend on what business does, doesn't just depend on what the consumer does, it depends on what the virus does and how sustainable this relaxation of lockdowns, which is now pretty much happening across the developed world. In the emerging world, things aren't going so well. They're behind the curve in a number of senses, and infections are picking up in a number of countries still there, unlike in the West or developed world, where infection rates and mortality rates are now falling significantly. But the overall pattern is that lockdowns are now clearly being relaxed, albeit fairly slowly, and this is starting to feed through, or should start to feed through, to an improvement in economic activity. So, at the peak, we were looking at a hit to global GDP of around 16%. Possibly in the last month or so, we've sort of clawed back around 3% of that. So we're only sort of looking at a hit of around 13%. So all good so far, but we are certainly not out of the woods yet. And very much, we still think the market has come too far too fast. Sure, things are improving, lockdowns are being relaxed, infection rates are coming down, activity is starting to pick up, but the market seems to be discounting all of this and more. So short term at least, we do think the markets are still vulnerable to correction. We raised a bit of cash a few weeks ago, and still the plan is, if we do get something of a correction, we'll be reinvesting that money at more attractive prices. Anyway, that's our views for the moment, and I will be back next Monday with an update. Thank you.